Good afternoon, and thanks for joining us for today's webinar, Business Accounting and Tax Year-End Tune-Up. How exciting. It's going to be an exciting webinar. My name is David Blain. I'm a partner at McKonly Asbury, and joining me today are Director Lindsay Young. Lindsay, say hi.
Good afternoon, everyone.
Manager Zach McLaren.
Hello, everyone.
And Manager Matt Burns.
Good afternoon.
All right. If you're not familiar with us, McKonly Asbury is an accounting and business advisory firm with offices in Camp Hill, Lancaster, Bloomsburg, and now in Philadelphia, Pennsylvania. We offer a wide range of services to organizations in various industries. For more information, please visit our website, and that's www.macpas.com. If you joined us on past webinars, welcome back. If you haven't, our monthly webinars feature various business topics to keep you updated on what's going on around us. Be sure to check out our website to catch past presentations as well as current information throughout our blog. All right, if you haven't heard, our firm is celebrating an exciting accomplishment. We have been named the #1 ranked firm in the nation in the mid-sized firms category of Accounting Today's 2024 Best Firms to Work For. Huge accomplishment. The firm's really proud of this. Accounting Today partners with the best companies, group to identify the best 100 firms to work for across the United States. So huge accomplishment for our firm. Really excited about this. And we have also been ranked in the top 10 in best accounting firms for women as well. So again, another accomplishment that we don't have lined out here, but is definitely another great accomplishment for the firm. Okay, to note, polling questions will pop up on the screen. And as you can see, the first polling question is already there. So while you're thinking about that polling question, let me tell you this. If you have any questions for us during today's presentation, please submit them through the built-in questions function in the webinar control panel, and we will do our best to answer them during and after the webinar. For those of you, now listen up everybody, this is important. For those of you that are looking to obtain CPE credit for today's webinar, please keep in mind that there will be 4, and I repeat, 4 polling questions throughout the presentation, and you must answer all 4 of those questions to get your certificate via email a few weeks after the webinar. In order for attendees to be eligible, you must answer via the polling submission. We will not accept late responses. So please pay attention to the polling questions as they come up. We will remind you in advance before they do pop up that they're coming so you can be paying attention. But I'm sure everybody's gonna be paying attention because this is an exciting topic today that we're gonna be talking about. So the results are in. 90% of you are looking for CPE. So again, 4 polling questions, pay attention. All right, here we go. We're gonna rock and roll. We're gonna move this thing on. First item we're gonna talk about, and it's an exciting topic, is 1099 reporting. And our good friend here, Matt Burns, who is a new manager in our Entrepreneurial Accounting Solutions group, is gonna talk a little bit about 1099s. Matt, how you feeling today?
Feeling good. Feeling good. Thank you, Dave.
Good. You ready?
Ready to go.
All right, let me turn it over to you.
All right. Thank you very much. And everyone that's joined, thank you for joining us today. As Dave said, we're going to kick off with 1099 reporting. So we move into Q4, especially our group here at McKonly Asbury, the EAS group, Entrepreneurial Accounting Solutions. We are starting to ramp up our work on this with clients and just really gearing up for a successful year end and smooth reporting season kicking off in January for this. So as a business owner, you are required to issue 1099s to qualifying vendors. And we'll get into a little bit more detail on who are qualifying vendors in the upcoming slides as well. But the first step to good 1099 reporting, it all starts with the W-9s. So we're going to go through some best practices and really what you need to start this process. So the easy answer here is whenever you pay a new vendor, ask them for a W-9. With this W-9, you're going to get their name, what type of entity selection they are. You need to have them sign it. and then they're going to either put their social security number or their EIN on there, whatever, depending on the entity they are. So you always want to request this. That'll really help you out later in the later stages if you just request it up front. Another best practice, do a quarterly review of your books. Go in, because it is, if you're paying a lot of vendors or if you're a small business owner and you've got a lot on your plate, maybe you have a small accounting team, there's always another project that you need to be working on. So if you can, go in quarterly, do a quick vendor review. Make sure you have a W-9 for all these vendors that may qualify. And if not, ask the question now, because it's a lot easier to do it throughout the year than it is when you get into January, and they're also busy closing their books, preparing for tax time as well. Another way you can prepare.
I was going to say to you, Matt, that is one thing, right? I mean, we see this often where we have, you know, we're tracking down W-9s or trying to help our clients track down W-9s on January 26th when they need to be filed January 31st. So, you know, again, your quarterly review comment, I think, is really important.
Yeah, no, it really does help in January, and it prevents that rush at the end, because when you're rushing leading up to a deadline, that's when you miss something, or, you know, you have small errors. So if you can avoid it, do it throughout the year there. Some other areas would be mapping your GL software if possible. We work with a lot of clients that are on QuickBooks and QuickBooks Online, and this is something you can do. You can go in and you can code, you can map to specific accounts, and we're going to go over some of those key accounts here as well in the upcoming slides. Another best practice for your W-9s, retention of the W-9s. Keep them for at least 4 years. Keep the 1099s you issue for at least 4 years, because the IRS has 3 years from the date that the 1099 was filed. And kind of corresponding with that, maybe you're using a vendor for 4 years, maybe you're not. But when you hit that 4-year mark, it's always good to just reach out and ask for a new one, because maybe they've moved their business, so they have a new address. Maybe they've switched their entity type. Maybe they have a new election, and that might change some things for them. So it never hurts to do that. Also, with best practices, look back and see if you've received any sort of IRS notice from a prior year. The ones that we typically see come in the office are the taxpayer identification number doesn't match, or the address doesn't match to the tax return that was filed. So if you get one of those notices, go back to that vendor, have them fill out a new W-9. And then another thing, so what if a vendor refuses to give you a W-9? And we do see this occasionally. Hopefully you don't see it a lot, but if you do, you just want to make sure you do your due diligence. Make 3 attempts to contact the vendor, preferably via email, because that way you have that documentation. And this is what the IRS recommends. They want you to have that documentation. And if you're still not getting it from them, what you're going to need to start doing is you have to start backup withholding of 24%, which is right out of the IRS guidelines. Normally, if you send that email out, you get a pretty quick response from vendors. So hopefully it doesn't go to that. And like I said before, you can always avoid this by asking for a W-9 with the first payment. Next. So we're going to talk about who qualifies now. Individuals, LLCs, partnerships, any vendors that were sent payments of $600 or more. There's some others like rents and royalties that we'll discuss as well. And along with this, you might notice I didn't say anything about corporations, or if they've elected an S corporation status, if they mark that box on their W-9. Corporations and S corps do not require the filing of 1099s. And we'll talk about some more subtleties with those a little bit later here. So what type of payments? Services provided in the course or trade of a business, casual labor, and I feel like a lot of people, they immediately think, who are my subcontractors? And just think that's it. But there's some key accounts that we'd recommend that you need to go through. Look through if you have cleaning companies. Do you have rentals, lease and equipment, legal and professional fees, services, really any type of services, your landscapers, design, development, your independent contractors, if you have haulers, computer services. So there really is a wide array, and you want to go through these key accounts to verify, look at their W-9s, and see if they fall in to a category where you need to report on them. We can go to the next slide, please. So there's three key, there's a lot of 1099s out there, but the three that we deal mostly with here are the 1099 NEC, the 1099 MIS, and the 1099 interest. Majority of your payments or issuing of 1099s are going to be on that NEC. That's majority of your vendors. So if they are an individual, if they're an LLC that's not taxed as an S corp, those are going to be on your NEC. So all those services we talked about, cleaning companies, your accounting providers, any sort of independent contractors you have, if you have your landscapers, anyone that maybe came in and did some maintenance for you as well, you would include them there. On your 1099 miscellaneous, that's where you're going to see your rent payments. That's where you're going to see your royalties. With your royalties, you're going to see that it's for $10 or more. So there is a difference there with the $600. Typically see this if you own a franchise. Typically have royalty payments there. You might see this from oil and gas as well. So those are some of the key items. Now, with some subtleties, you'll see legal fees are on the slide there. So if you've paid an attorney $600 through the course of your trade or business throughout the year, you do need to issue them a 1099 NEC. However, if they give you a W-9 that's marked as an S corp, you actually still need to issue them a 1099 NEC. This is the one vendor that does not follow the general rule of if you're an S corp, you don't need one. For attorney fees, you always have to issue that 1099. A little bit more when it comes to attorneys, if you have any gross proceeds from a settlement, those will also be reported on a 1099, but that's actually going to be on your 1099 miscellaneous in box 10. As we go through here, we're going to talk about credit cards. So a lot of the 1099 payments, if you're paying them directly from your bank account, you're writing them a check, you're doing an ACH, you're using your debit card, anything like that, you need to report anything $600 and more on your 1099, the corresponding one. If you're paying a vendor with a credit card, you do not want to include those payments. Even if they're over $600, you don't want to include those on your 1099. So maybe you pay a vendor $600 via check, they're going to get a 1099 NEC. If you pay them another $600 and it's through a credit card, you're not going to include that because it's actually going to run through the third-party payment processor, and that's going to come through on their 1099K that they receive. We can go to the next slide, please. So as I mentioned, 1099Ks, there's been a lot of updates around this. So still kind of changing, and not necessarily, wouldn't say it's a firm answer because on the IRS website, they truly use the word planning. So this is reporting of sales through apps, platforms, and PSEs, which are payment settlement entities, which is your PayPal, your Venmo, your eBay. And if any of you use Amazon, you'll get a 1099K. So through the American Rescue Plan Act, the goal was to change this for 2023 from the $20,000 and 200 transactions all the way down to $600. However, there were some concerns over this that were brought up by CPAs and everyone in the professional world, and just the kind of timing of it and the threshold. So the IRS actually delayed it. So the plan in 2024 is to adjust it in phases until they get it where it was originally supposed to be at that $600 amount. And maybe they don't go all the way down to $600, but the plan now for 2024 is If you have $5,000 worth of sales through any of these apps or platforms, you should expect to get a 1099K. And we're going to discuss the importance of what you need to do with that 1099K as we go into our next section here. But just be aware of that. And first thing you would do, make sure it's accurate. Make sure it aligns with what you have in your books. Some other things here that you wanna pay attention to with the 1099K is if you have a business and maybe use some of these platforms too personally, the easiest way to make sure you're not getting personal items mixed in with your business is keep them separate. Keep business business and personal personal. That will alleviate a lot of pain, but if you are using something similar, make sure you're tagging the transactions accordingly. Because this really came up whenever we went through the COVID time there, and there's a lot of, the gig workers, economy and stuff like that. They felt that we were, the government was missing out on revenue that wasn't being reported because of this $20,000 threshold. So these are some of the changes. They still might change. And we continue to monitor this, and we'll probably be putting another blog out later this year about where they end up as we go into year end. And I think we have our polling question too then.
Yeah, so now we're going to move on to our next polling question. For which reason are you joining this webinar? You can take a look at those. You can take a look again at those options there. I know a lot of us already said CPEs, but you might be thinking about tips and tricks to improve your year-end or 1099 reporting or tax law matters, all of the above, who knows? But let's give you a second there to answer that question. While everybody's thinking there, next item that we're going to go to will be Lindsay Young, who's going to be taking lead on talking about some year-end tips and tricks on year-end reporting and closing. And Lindsay's been with the firm for over 20 years, and she loves this stuff. She loves year-end reporting. She loves year-end financial statements. That's what Lindsay does, and I'm sure Lindsay's going to rock and roll with this presentation coming up here. So let's take a look. So 20% CPs, obviously 62% all of the above. So good. I'm glad to hear that. That looks to me like a lot of this stuff that we're going to talk about here is going to be important. So all right, let's move right along. Moving off of polling question number 2. We're now going to get into some internal accounting year-end checklist matters and things that we should be paying attention to as we go into year-end here and getting ready to close our books and file tax returns. So let me turn it over to Lindsay.
Thank you, Dave. If anybody knows me, everybody knows that I love a good balance sheet. I think it talks volumes about your business. It tells a little bit of the story of who you are, where you're going, what you've done, and the growth opportunities that are out there. So I love a good balance sheet, but it needs to be ticked and tied out. And I can't stress that enough. So we are going to walk through our balance sheet with a couple of recommendations coming into our year-end close. First and foremost, cash is still king. This is a Dave Blain saying. If you
That's right.
Know him, cash is king. And
nothing unique about cash, right? Cash is cash. Let's make sure it is appropriately managed and monitored.
That's right. And I think we do that by ensuring that we are looking at our year-end bank recs. We are pausing, asking ourselves the question, are there duplicated transactions that have not cleared throughout the year? Do we need to be making current period adjustments and making sure that we're not interrupting anything that was presented on a prior period or a prior period tax return, but instead making current period adjustments? Do checks need to be reissued? You'd be surprised at the amount of times we have seen clients with outstanding payroll checks to employees and or just checks to vendors that haven't cleared. Matt actually has a pretty cool real-time story for us on why it's important to look at your balance sheet. Matt, do you want to share that story?
Yes, thanks, Lindsay. So I was working with a client last year, and we're going down through the balance sheet, looking at the reconciliations, and I think you mentioned it. You want to see if, do the outstanding items make sense? And one of the things we noticed was there was a deposit that was still outstanding. It wasn't near the end of a month, like it, maybe hit on a weekend or something along those lines. It was probably a couple months out. So we questioned the client on it, and they went back to their bank, and it turns out that the bank deposited it into someone else's account. They were able to work with them, get that money back, and it was actually a couple $1,000s. So it's really important that you do look at those uncleared transactions and make sure they make sense. In this instance, it got them thousands of dollars that were truly missing at the time.
Thanks, Matt, for taking a moment and sharing that story. Like I said, it's really important. Cash is still king, and we want to make sure that we've accounted for all of that cash. And that's why it's so important to review your year-end bank reconciliations. On occasion, we do see those outstanding transactions for employees that have moved, aren't available, maybe haven't cashed that final payroll check, and even a vendor check. Matt, can I ask you one more question? What do we do with those?
So if you have an item that's still outstanding, hasn't cleared, you do need to be aware of the PA unclaimed property and the dormancy rules. They have a matrix out there, and depending on what type of transaction it is, there's a different time frame of how long you can let it outstanding before you need to submit it to the state. Along with that, there's paperwork, there's additional filings, and then you'll have to continuously file these reports on an annual basis.
Thanks, Matt, for helping with that cash and cash rec kind of things. Same thing applies with our credit card transactions. We need to be pausing, taking a step back, asking ourselves, gosh, that Amazon transaction did not clear. And they are classic for breaking down transactions that you thought you purchased all at once into 3 smaller, more minuscule transactions. And we often see clients posting at the larger amount, something is uncleared, and just making sure we're double checking that. Next slide, please. As we are looking through our fixed assets, we want to make sure any of those new purchases that you have made throughout the year are being recorded as such, that we are tracking and maintaining our documentation. Really, we're working with a capitalization policy for most of our clients of about $2,500. Some have more, some have less, but I would say the majority are right at that $2,500 amount. We love to see invoices, so please send them over to us in connection with reporting your year-end tax. Kind of pausing and asking yourself, have you sold something this year? Has it been properly reported, and are you removing it from your fixed asset ledger along with its accumulated depreciation? If not, let's earmark that so we can get some help booking that transaction as well. We also want to make sure that we are booking depreciation, that we've assessed an appropriate useful life against the product or the item that we have purchased. And we want to make sure that we are kind of just making sure we're buttoned up in the fixed asset category. We often see sales of old items. Maybe they've been donated, and we do want to make sure they get removed from the ledger. That's important. You're going to hear Zach talk about depreciation a little bit later in our presentation, but it is just a good exercise to make sure that the assets we truly do have on file are the ones we actually have on file. From an inventory perspective, we want to make sure that at least on a quarterly, at a minimum annually, we're really digging in and doing that physical inventory count and making sure that the inventory we do have on the floor matches what is actually showing on our balance sheet. If we do have old or obsolescence that we need to take into account, we do want to make the journal entries to remove those items off the books and get the profit and loss statement impact that we're looking for. Accounts receivable, I'm going to ask Matt here in just a minute to highlight CECL for us, but we do want to do that subledger review. We want to look at the individual accounts that we have out there. We want to make sure they are truly collectible. We want to make sure they're accurate. Time and time again, we see that there's, oh, well, that client paid a long time ago. Why are they still there? We want to make sure that they get matched up. If there are adjustments that need to be made, we want to book those credit memos in real time, so you're not paying any more tax than what you have to. We also want to make sure, if need be, we have that appropriate reserve for AR. Matt, what do you have to say about the new CECL implementation?
Thanks, Lindsay. So CECL stands for Current Expected Credit Losses. Keep it real high level here. It's a new issuance under FASB, under ASU 2016-13. It went into effect for all non-public companies starting after December 15th, 2022. So it's really a mindset shift here. And if you have any accounts receivable that would qualify under this standard, what you're really doing, instead of writing it off later or booking allowance for that, you're changing the mindset to booking that expected loss right then and there up front. So when you book through accounts receivable, if you know that maybe 3% of this is normally uncollectible, you want to book it now. So that keeps real high level, and we have a team here that deals a lot with this and can provide a lot of additional guidance on it here as well. But that's real high level basics, and if you're not sure of that standard, let us know. We'll go back to you, Lindsay, now for the debt.
Thanks, Matt. And then on the debt side of things, we want to make sure that we are breaking out current and long-term portions where applicable, updating those at year end. We want to make sure, you'd be surprised at the amount of people we see or client accounts that just haven't broken out interest for the year. All 12 payments that they've made on a particular loan get recorded on the balance sheet, and we're really skewing what our actual liabilities are. So we do want to make sure that we go back and we break out interest expense. We want to be tying to any third-party debt schedules. We want to be tying into liability balances, or maybe even an intercompany balance that might be presented on another balance sheet for a related party, or maybe a real estate entity that we might own as well. Another one of the standards that we have been working with our clients on implementing is the lease implementation under ASC 842. Operating leases that might qualify under this standard, we are booking them and their respective debt obligations, and we want to make sure that we're doing that in real time. And so if you have questions on whether the lease implementation standard is applicable to you, we'd love to have a further discussion about that. Next slide, please. Some of the other matters that we kind of take a look at when we're kind of digging into that year-end balance sheet is making sure we're tying into an underlying prepaid schedule. Any releasing of expenses that have happened throughout the year that haven't been properly recorded or booked, we want to make sure we get those kind of tied into that underlying schedule, and that the expense that you are expecting to see gets recorded in the appropriate time and realized in good fashion. Additionally, we see clients tracking security deposits and or security deposit liabilities. And a couple of times this past year, we've seen where there are old items or maybe locations that we're no longer using, where it kind of goes back how Matt shared found money, where clients said, oh, I haven't been there in a year and a half. And we're like, well, do they owe you this deposit back? And then sure enough, they really do. So it's kind of found cash. So making sure that the security deposits are truly deposits you have on file for locations or spaces that you are using on a regular basis. We've also seen the latter, which is Maybe you vacated that space and they used a portion of it to change the locks, maybe install a fresh coat of paint, or maybe restore it back to its original, and they've retained your security deposit and have used it towards rent or repairs and maintenance expense. And we actually want to see, because you aren't getting that refund back in cash, we want to make sure you're actually getting the expense and that's being booked on your profit and loss statement. Other items that we want to make sure that we're taking a look at from time to time, especially in QuickBooks, it tries to do some thinking for you. And we see uncategorized assets. We see payroll liabilities that aren't properly clearing, and just making sure you are buttoning up those balances and kind of can really say without a doubt those are true and actual. We are looking at clients' deferred revenue schedules, verifying accurate balances, and that income is being recognized in a correct period or in a correct year. So those are two other important items. In the equity section, oftentimes we like to do a quick little verification that all prior year closing entries have been booked in client accounts. We see it oftentimes when we take on new accounts where prior closing entries from a prior tax accountant or an internal account may not have been posted in the books. And that really creates a hard starting space for us to do a tax return. So it's really important that we make sure equity is properly closed out, distributions are closed out to appropriate equity accounts, that current year distributions are reviewed for accuracy, and just making sure that we aren't erroneously posting adjustments to equity accounts that don't need to be there. So a common one we see is when QuickBooks Online connects a new credit card or a bank account, oftentimes it'll show up with this new account called opening balance equity. When you add that account for the first time, inherently there's an existing balance there. And for one or more reasons, it posts it there to get that account started. And in reality, that's probably not accurate. So we just need to dig into the details, make sure our cash recs are up to date, make sure that transfer to that new account or that existing balance is addressed up front. Next slide, please.
Yeah, Lindsay, just real quick on that equity tax return. Of all the things that we see there, that's usually the item that we see the most. Where either equity wasn't booked or wasn't cleared from the prior year, or distributions paid to owners were not properly classified.
Dave, I can't agree enough. And honestly, it really creates inefficiencies when those items aren't kind of ticked and tied out to start out a tax return or get us into a good year-end close space. It really needs to be item number one, making sure we got a good starting space for the current year, for the current tax season, and it really just drives efficiency. Kind of moving into the profit and loss statement, I don't want to steal any of Zach's upcoming thunder, but he is going to highlight from a tax perspective several of these items as well and their specific tax impact. But from a really high level, we want to make sure that some of those key tax forms that Matt may have referenced earlier, that we are tying out wages that are being paid. So we might be using 3 or 4 chart of accounts to classify wages on a profit and loss statement. We want to make sure that those are talking to and tying back to the underlying annual W-2 and W-3 reporting. Specifically, they tie usually into Medicare wages. Of course, there are adjustments for things out there, but we want to make sure that we can tie out year-to-date reported wages back to the underlying tax form. Like I said, we'll hear more on tax deductibility about meals and entertainment, but with the Tax Cuts and Jobs Act from 2018, really it's not a combined account anymore. We really like to see at least 2, if not 3 charts of accounts to appropriately track and maintain meals and entertainment. The first meals account is going to be your 50% account, which is going to have the majority of your spend around the meals and entertainment. That's going to be your restaurant, your drinks, that kind of stuff. Entertainment is going to be purely tickets, sporting events, golf outings, really your non-deductible entertainment amounts. And the final one, we do have a handful of clients that are doing an annual holiday party, and those items really should be tracked in 100% deductibility for a meals-100% account. So we want to make sure that we are tracking those and looking at those. That speeds up our tax return preparation and adjustments we may need to make to get from the books to our tax return. And that, like I said, don't want to steal Zach's thunder, so you'll hear more about that as well. Contributions, we want to make sure that the actual charitable contribution line on your profit and loss statement is really filled with contributions that are qualified 501c3 organizations. You can set up a non-deductible charitable contribution. Those should be for your political or GoFundMe items. Other times we do see where clients are getting letters and documentation. We want to save those to the file. Those are always good support, especially from your 501c3 organizations. But also we do see where clients are maybe putting an ad in a local brochure or in kind of doing some advertising and sponsoring somebody. Those may not always go to 501c3s, and sometimes we see them in that charitable contribution amount. Let's maybe update those and classify them as advertising, marketing, or a sponsorship category if we are doing those. So that's another one that we do like to kind of clean up and get into a good fashion to make our tax return process efficient at the end of the year. Next slide, please. I don't want to rush me too much here, but I am going to kind of speed up a couple of these year-end things specific to repairs and maintenance. We do like to dig into those accounts. We're looking for items over that capitalization policy we talked about before. Zach's going to get into our depreciation. And additionally, we do kind of want to pause. I have an example here where last year we had a client who did a rebuild of an engine. It was an $8,000 purchase, but they snuck it in that repairs and maintenance account. We did take a step back. You know, really that is bettering the item. It's extending the life beyond, and we really are wanting to make sure that gets picked up as a capital asset. And subsequently depreciated. Matt, I'm going to turn it over to you real quick to talk just briefly about mileage.
Yeah, so you've got two options here. You can either do mileage or actual. With the actual, you know, you're going to take depreciation. You can take the repairs and maintenance, the gas, depending on what the percentage of business usage is. The key here is once you select one, is staying consistent with it. In year one, you can take mileage, and then in year two, you could switch to actual, but once you make that change, you must remain with actual going forward. If you're doing mileage, there's some apps that we've seen that are very useful, they're efficient, and they really help you with your records. That's MileIQ, and if you're a QBO user, they have tracking in there where you can very easily log your miles that can be booked later. You can tag them if they're personal, if they're business mileage. It's very easy then to give to your accountant, makes them booking that entry a lot easier as well. And if you were ever to get contacted by the IRS, you have that support. The key here though is retain your records just in case. Go back to Lindsay now for the revenue.
Awesome, thanks, Matt. One of the items we like to just button up at the end of the year is revenue, transactions, and those 1099Ks that we are getting from those external platforms, your Amazon, your Etsy, your eBay, your Stripe, and more. A lot of times the client are just depositing those net amounts and those net bank transactions directly to your revenue line, and we aren't breaking out things like merchant fees. Sometimes we see that they will pick up various returns that need to be done. So we want to make sure we're going back and capturing true gross income and really tying those out to those forms that might be received. Next slide, please. I would just kind of wrap it up here before we go into an upcoming polling question. What do I do with all those tax documents that came, and what can I really do to make tax return processing time easy breezy? Make sure you have that capitalization policy on file. Double check to make sure that you've really looked through those repairs and those maintenance accounts and get those up. Record retention, really all items really have a 7-year bank statements, deposits, checks, invoices, tax returns, receipts, making sure you adhere to that 7-year policy. Employee files, organizational documents, setup documents really ought to be maintained into perpetuity. Additionally, we want to make sure kind of finally those tax files and documents that you're receiving, 1099s, your interest, dividends, NECs, we want to be kind of totaling up what people are saying they've submitted to you for revenue, and we want to make sure that actually ties back or exceeds the revenue you're reporting on your tax return. This will help us avoid notices and make sure that you're really looking and I'm sure Dave could tell you too, from a business valuation, you want to report all your gross revenue, as much of it as you can. Making sure you're tying into your 1098s, showing any interest expense and kind of doing a double check there. Looking at those W-3s. And then finally, if you have any mercantile returns, send those along. Let us help you prepare those, make sure you're reporting those accurately. New year, be looking out for a change in rates for any filing frequencies you have, as well as your unemployment compensation rate. We want to make sure those get over and that you start withholding at the right rate and are on the right frequency at the start of the new year. Dave, I think I'm going to turn it back over to you for an upcoming polling question.
All right, I think we're on the polling question number 3. You know, which type of business are you? Cash basis, accrual basis, or other? Let's give everybody a minute here to answer that question, and then after this, we're going to move on to Zach McLaren, tax manager here at McKonly Asbury. He's going to give us a tax update, some updates on things to think about before you go into year end. So, Zach, how you doing?
Oh, we're doing fantastic, Dave. How are you?
Fantastic. I'm fantastic as well, Zach. I can't complain. So, all right. I think we should be able to close this polling question here. See what the answers are. Okay. So accrual, wow, 50% is accrual. Another 28% is cash basis. So, okay. All right. Well, let's move on since we're almost at 2:45 here, and we still got one more polling question to go to. And I'm going to turn it over to Zach to give us a year-end tax compliance update.
Yeah, everyone's favorite topic, income tax compliance. So as Lindsay mentioned, there are a handful of things that need to be clearly identified on your P&L. And what we're really concerned about is the non-deductible expenses, things such as meals, entertainment, country club fees, and political campaign contributions, things of that nature. If you're going to hide them in other accounts for internal reporting purposes, just make sure that you're providing some sort of external schedule to make sure that the tax preparer knows that you put money into political campaign contributions, or you have a country club membership, or whatever that may be. Then for review of repairs and maintenance accounts, Lindsay mentioned that the capitalization policy is $2,500. That oddly coincides with the IRS requirement for de minimis safe harbor. So anything over $2,500, you really should be kind of looking at and saying, hey, is this is this a repair, or is it something that is a capital improvement to an asset or a new acquisition or something of that nature, just so that if it does need to be capitalized and depreciated, you're not surprised at year end when there's a $100,000 adjustment because you put an addition onto a building that you expensed, and then on the tax return you think you're at a loss, but in reality you're 100 grand in profit. So there's some key items to kind of keep an eye out for. In 2023, moving on to the self-employed health insurance, the IRS issued a new form, which is a 7206, self-employed health insurance deductions. They're essentially saying here that if your health insurance isn't correctly reported, that it's most likely not going to be deductible. So for S Corp owners that are greater than 2%, we're looking at that needs to be reported on your W-2, box 1, and then in other information with health insurance. For partnerships, it needs to be listed on your K1 as a guaranteed payment, and then other deductions for medical on that same K1. They're really kind of starting to look at these things and make sure that people are in fact reporting correctly, make sure no double dipping is occurring for health insurance, just trying to true things up from a tax perspective. Then kind of going on the S Corp owners here, you're required to take a reasonable compensation. S Corp, so one of the benefits is that the earnings from it are not subject to your self-employment income tax or self-employment taxes. And for the IRS to recoup those, you're required to take salary. And that's where, in fact, you're paying those self-employment taxes on your W-2. So what the IRS doesn't want to see is that you're taking a salary of $30,000 and then $300,000 distribution out of the business in a given year. It's okay if the business is struggling and you're taking a reduced salary that year, but it's in those years where you're earning significant income and payroll is not what it should be, and you need to year end you're emptying out the account in a distribution. So the IRS wants to collect those FICA taxes. If that's where you are currently, there's plenty of time yet before year end to correct that and make sure that you are taking a reasonable salary. There's a number of ways to determine what actually is reasonable. That's a different CPE. So yeah, you as an S Corp owner, you need to pay yourself. Then moving on to basis. This is one of my favorite topics and is probably one of the things that is most neglected. A lot of times we see no basis schedules, anything for businesses that come through. And basis is extremely important. It determines whether a loss is deductible in any given year. It determines if a distribution is taxable. Usually from pass-through entities, they shouldn't be, but if you don't have any basis, there's a good possibility that it is. And also if you turn around and try to sell your business, you need to know what your basis is, because that's going to be the determination for whether it's a gain or a loss. So, and kind of similar to the 7206, the IRS issued another form called 7203 for S Corps, which has to be now attached to the tax return in any year that you're deducting a loss. You're doing distributions. So those are some key things. If you're looking at your prior year tax return and you have no idea if basis schedules are there or if basis has ever been kept, it's going to be going back. It can easily be reconstructed. It's just a little time consuming. So it's not the end of the world if you haven't been keeping basis up to date, but it's something to probably do before year end, get the 2023 basis correct so we can look at 2024 basis. You can go to the next slide then. All right, as Lindsay mentioned, 2024 depreciation. So there are two main types of accelerated depreciation. It's bonus depreciation and Section 179. Bonus was 100% back in 2022, and it's dropping 20% every single year until 2027 when it hits 0. So for this upcoming year, we're looking at 60% of the cost of the asset can be deducted. And then for Section 179 for 2024, the limit increased to about 1.2 million. And then if you pay or place over 3 million in assets, it starts to phase out dollar for dollar. I hear a lot of people say use bonus and Section 179 interchangeably, and there is differences. And so what I guess is that, what is the difference between bonus and Section 179? And then you can go to the next slide. So here's a quick cheat sheet for people that kind of get confused with what the actual difference is between Section 179 and bonus. Depreciable life of assets, anything under 20-year assets is going to be or bonus, and Section 179 is going to be allowed. So asset type essentially equal to each other. And those assets are going to be machinery, equipment, cars, or vehicles, computers, furniture, things of that nature are going to be subject to bonus and 179. The main difference between the two is going to be that bonus depreciation can create a taxable loss. So that can take you from profit into the negatives, and it can offset other income. Section 179 is going to be limited to the profit for the year. So it can take you to 0, but it can't go below it. And then as we just kind of talked about, there are thresholds. Bonus can't get phased out where Section 179 can. First year depreciation limits are going to be 60%, and then 1.2 million for Section 179. Interesting is that bonus requires you to elect out. It is a mandatory depreciation. So, and you have to elect out on an asset class. So it's either 5-year property, 7-year property, 10-year. You can't pick and choose specific assets. It's going to be all or nothing when it comes to the asset life. Section 179, you can elect to do $1 of depreciation of Section 179 if you wanted to. And then for PA, bonus is not allowed, and Section 179 is a recent change for Pennsylvania, where it was 25% or $25,000. It got up to the federal limit. And you can change to the next slide.
Zach, quick question that just came in here is, can you take both at the same time?
So yes, you can take both. In any given tax year, you can take Section 179 and take bonus depreciation. So moving on to state tax items. For Pennsylvania's corporate net income tax, that rate dropped to 8.49% in 2024. It's going to drop 0.5% every single year until 2031, where the rate's going to be at 4.99. Just as I mentioned a couple seconds ago, PA is now following federal rules for Section 179. And then looking forward to 2025, the PA Department, or Pennsylvania, is now allowing employers to contribute to employees' 529 plans, and they can take a 25% credit on the contribution up to $500. There's not a ton of information out there on this quite yet because it's new, but just keep an eye out for that in Pennsylvania tax law news for what employers can be doing to save some PA tax dollars. And then lastly, on this is going to be the pass-through entity tax election. This has been out for some time. However, it's not heavily seen, and I think it's just lack of exposure. But in 2018, the Tax Cuts and Jobs Act reduced the amount you can take for state and local tax deduction on your 1040, limited to $10,000. A lot of states weren't happy about that because they were fearful of not being paid timely for their tax bills. So a few states started to implement this pass-through entity tax, which allows the pass-through entity, so an S corp or partnership, to deduct it at the entity level and that gets pushed through to the 1040, not on Schedule A, but it's just as a business deduction. So that is a huge savings to people, because I mean, some of the tax rates for states are quite high. We have a quick example here that we'll go to, just to show that you're talking about real dollars when you make these pass-through entity elections. If you can go to the next slide. So this is a PAS Corp with net income of 1.5 million. It does business in PA and New Jersey, and it has a apportionment factor of roughly 65%. So roughly 65% of that 1.5 million is going towards New Jersey state income tax. If you make the election in New Jersey, as you can see here, we're showing about $64,000 of state income tax. It actually reduces the 1.5 million down. You have a loss of QBI, which is fine, and you're saving a net of $51,000 in revenue and a tax savings of about $19,000 just by making an election, doing some extra paperwork. So it's definitely worth the extra time it takes to do this. And you go to the next slide. All right, some tax saving opportunities. I'm going to touch on a few of these real quick. Purchasing depreciable assets, that's the go-to for everyone. But you should only do this if you need the asset and it's a smart financial decision to you. Tax savings should never be the main driving goal behind making a large financial outlay. So make sure, one, you need the asset, and you're going to be buying it, or would be buying it within the next 2 months, 3 months, and that you're financially able to do so. Self-rentals and business use of home, these two things kind of coincide. A lot of times business owners don't actually use their, or a lot of times business owners use their home or workshop or something that they own personally, and they don't take the deduction for it. So that's one of those things that we can take little extra deductions on. We talked about PTE elections, retirement plan contributions. They're pretty straightforward. And then the last thing would be estate tax planning. This, in 2020, the federal exemption, which is 13.6 million, is going to sunset at the end of 2025. So there's some key tax planning things that you can do, whether that's setting up trust and gifting, whether that's business transition planning. In these next 14 months, that can be of significant value moving forward before this exemption sunsets here at the end of 2025.
Okay. Zach, thank you. I think we're on to the last polling question. What type of business entity tax return do you file? Is it a Schedule C on your 1040? Is it a pass-through entity partnership or S-corp return? Are you a C corporation? Maybe you're a nonprofit in a 990, or none of the above. So we'll give everybody a chance to answer that last polling question. And we have two other slides that are very quickly we'll run through when the polling question is done, and we'll close this thing out since we're almost at 3 o'clock. So I just want to say thank you to Zach and Lindsay and to Matt for their time today. I also want to thank our producer, Audrey. Audrey is our producer, and she's one that's moving the slides around here. And I don't think we give her enough kudos a lot of times when we do these webinars. So I just want to say thank you to Audrey for your time. So let's close the poll, see what the answers are there. Wow, pretty much most everybody's a pass-through entity, partnership, or an S corporation. Okay, that's great. So we'll move on to the last 2 slides that are on here real quick. Just real quick, going into next year, a couple things to keep in mind: changing interest rate environment. The Feds are projecting another 25 to 50 basis point reduction as you're looking at your year end going into 2025. Look at your debt. Look at what those interest rates look like, and you should always be looking at the potential refinance to create some additional cash flow for you. The beneficial ownership information reporting. That's been a big talk here in 2024. If you're an entity that's an entity that qualifies under this, you have to have that filed by January 1st, 2025. If you formed any new entities in 2024, you should have been filing those within the 90 days of filing of starting the entity. So make sure you work with your attorneys in making sure that you have those VOI forms filed. And then finally, last thing to keep in mind, which Zach just kind of hit on to, we can go into the last slide there. It's just future tax code changes. A lot of the tax laws from 2017 are sunsetting at the end of 2025. You want to look at what those cash flow impacts are of those tax law changes, and also what that does to the value of your business. Some things to just keep in mind. So with that said, we'll go into closing remarks here. I just want to say thank you for joining us for today's webinar. If you have any further questions regarding today's presentation, please feel free to reach out. Our team would be happy to assist. A recording of today's presentation will be posted on our website, social media sites in a few days. And for those of you who requested CP and answered the polling questions, those certificates will be sent out within the next 2 weeks. Upcoming events, we got another webinar here on November 21st. Join us for our next webinar where our AEC team will be providing a 2024-25 construction tax planning and accounting update, along with special guests from tax consulting firm KPKG. With that being said, it's just past 3 o'clock. I just want to say thank you again for your time and enjoy the rest of your day.